Hi all, good evening and welcome. I'm Divya Gopalakrishnan, and on behalf of CareEdge, I welcome you to our today's discussion on small finance banks geared up for growth. We sincerely appreciate your time in joining us for this webinar. We would like to welcome our esteemed guest speakers for today, Mr. Samit Ghosh, Non-Executive Director and Chairman, Ujjivan Financial Service Limited, Mr. P. N. Vasudevan, MD and CEO, Equitas Small Finance Bank, and Mr. Shrimohan Yadav, who's an advisor in the financial service industry. This session will be moderated by Sudhakar Prakasam, Director at CareEdge Ratings. We will commence this session with a presentation by Ravi Nayak, Assistant Director, CareEdge Ratings. This will be followed by a panel discussion and a Q&A session. In case of queries, participants are requested to key in your panel. We will take up all your queries during our panel discussion session. Now, may I invite Mr. Ravi to make his presentation, please?
Yeah, thanks, Divya, and good afternoon, everyone. Welcome to CareEdge Ratings webinar on Small Finance Bank Geared Up for Growth. Small Finance Bank journey has been anything but easy, starting from the demonetization after effects, NBFC crisis of 2018, private banks fiasco of 2020, and lastly, COVID-19. The SFB industry has shown resilience and has been growing faster than the overall banking industry. COVID had resulted in deterioration of asset quality and profitability with reduction of capital cushions as SFBs continue to undertake rapid advances growth. With need for capital raising had emerged as a challenge to the growth momentum. Now, with COVID scare behind us and improvement in economic landscape, there is a sharp improvement in asset quality and financial performance of SFBs. This has resulted in capturing investor interest for the sector, with some players raising equity through their maiden IPOs in FY23 and in current year as well. With better asset quality, improving profits, and strengthening of capital position, the sector has strong growth potential. While organic growth continues, there have been announcements of a couple of mergers, largely for inorganic growth. Major takeaways in this presentation are SFBs expanding their branches geographically across India, gain of market share in deposits with improvement in CASA, strong growth of advances and gain of market share with focus on non-microfinance loans, improvement in asset quality and decline in credit cost, resulting in improved profitability. Capital challenges addressed, focus is now on growth. And last, mergers in the SFB industry. Let us look at the brief history of Small Finance Bank. The Union Budget for FY15 cited the need for differentiated small banks that would help financial inclusion in India, following which the RBI published the draft guidelines for licensing of Small Finance Bank in July 2014. The objective of having SFBs was to further financial inclusion by providing savings vehicle to the underserved and unserved sections of the population and supply credit to small business units, small and marginal farmers, micro and small enterprises, and other unorganized sector entities through high technology, low cost operations. RBI in September 2015 doled out in principle approval to 10 applicants, out of which 8 were given to MFI NBFCs, with only exception being AU Small Finance Bank and Capital Small Finance Bank. The first SFB became operational in April 2016, and over the next 2 years, another 9 SFBs received final license. During FY21 and 22, 2 more SFBs were given licenses, taking the total number of SFBs to 12. In this slide, we see the key differentiators between SFB and Universal Bank. SFBs require lower minimum capital of 200 crores versus 500 crore for Universal Bank. SFBs have a requirement to meet a target of 75% towards priority sector loans instead of 40% for Universal Bank. Higher CAR requirements at 15% against 11.5% for Universal Bank. 50% of total advances to be of ticket size of rupees 25 lakhs or below for SFBs. However, there is no such requirement for Universal Bank. SFBs are also required to open at least 25% of their branches in unbanked rural areas. There is no such restriction or requirement for universal bank. SFBs have been expanding their franchisee continuously, and the number of branches grew at a CAGR of 29% since March 2018 to around 7,100 as on September 2023. The branches are well spread out all over India, with South India having the highest number of branches at 28%, followed by Western region contributing 20%. The strong focus on building liabilities franchise comparable to that of universal banks has resulted in deposits growing faster than the banking industry. The chart shows that deposits and advances of SFBs grew at a CAGR of 32% and 26% respectively during the period of FY20 to FY23, as against CAGR of 11% for both credit and deposit for the banking sector. At the bottom of the chart, we can see that in each year, the growth in advances and deposit was more than twice of the banking sector. The faster growth has helped SFBs gain market share in advances and deposits of the overall banking industry over the past few years. As most of the SFBs transitioned from being NBFC MFIs, major challenges faced by them in the initial years was mobilization of deposits. SFBs have done a commendable job on this front and built a good deposit base by setting up liabilities-focused branches. The left chart shows the improvement in CD ratio of SFB over a period of time. However, the banking industry CD ratio is much better than that of the SFBs. Coming to the right-hand side chart, although the CASA has improved slowly over the years, the CASA proportion still lags behind that of the universal bank. Raising low-cost deposits has been a challenge for the SFB industry and will take a long time to reach the level of private and public sector banks. It is worthwhile to know that although CASA proportion improved, the cost of deposits still continues to be high as compared to universal banks. Part of the issue is with the public perception carried on with the small finance bank tag. SFBs have been raising awareness by building its franchisee and increasing its visibility by opening new branches, giving attractive interest rates, and through advertisements. We can see that in June 23, the CASA ratio has fallen faster for SFBs as compared to universal banks, indicating relatively lower stickiness of deposits. Here we can see as majority of SFBs transition from being microfinance institutions, the larger proportion of their loan book still continues to be skewed towards microfinance, which are entirely unsecured. There has been a gradual diversification of portfolios by SFBs with increasing share of secured products like home loans, LAP, mortgage loans, vehicle loans, and gold loans, resulting in the share of microfinance to decline from 40% of advances as on March 2020 to 32% of advances as on March 2023. Excluding AU Small Finance Bank, the MFI exposure has reduced from 59% as on March 2020 to 51% as on March 2023. Going forward, we expect the share of microfinance loan to reduce even further. The chart on the left and right shows the yields on advances and cost of funds being significantly higher than that of the banking industry. The yields for FY24 is expected to increase slightly as majority of advances has already been repriced in FY23. The cost of deposits is expected to rise sharply in FY24 as majority of deposits will come for renewal. Another factor for increase is the cost of deposit is the shift from CASA to term deposits. As a result, NIM for FY24 is likely to compress slightly as compared to FY23. The regulatory requirement in terms of meeting PSL targets and restriction on ticket size results in limited flexibility to undertake large size funding to corporates. Therefore, business per branch for SFB is significantly lower than public and private banks. The slide on the right shows the cost to income ratio being higher due to low scale of operations, relatively higher investment in technology, and requirement of opening 25% of branches in unbanked rural areas. The business of SFBs are more branch dependent, and some SFBs also operate exclusive liability branches, leading to relatively higher cost to income ratio. The asset quality of all lenders were impacted during FY21 and 22 due to COVID-induced economic slowdown. SFBs, especially those with larger exposure to unsecured loan book, were more severely impacted due to exposure to relatively weaker borrower segment. SFBs saw a jump in their NPAs, requiring higher credit cost. With the impact of COVID subsiding and resumption of economic activity, the asset quality has improved during FY23 and continues in the FY24 as well. The impact of COVID peaked in FY22 when the credit cost was the highest as SFBs undertook significant write-off with many posting losses. The situation improved in FY23 with all SFBs showing improved NIM due to rate hikes announced by RBI and return on total assets due to lower credit cost. The improvement continues even in the current year. This chart shows the median capitalization levels of small finance banks. The CAR cushion was depleted in FY22 due to losses and continued loan growth. In FY23, the capitalization levels have improved due to profitability returning and many SFBs raising equity. With significant capital in the kitty, SFBs have now the ability to grow their advance book even faster than previous years when there was a capital constraint. The regulations allow SFBs to raise Tier 2 capital to the extent of 100% of Tier 1 capital. However, at present, the proportion of Tier 2 capital is significantly lower for the SFB industry, indicating lower acceptance of their Tier 2 instruments. Many of the SFBs had planned to raise capital in FY22 and even filed DRHP, but were unable to raise equity within the expected timelines due to volatility in stock market and low investor appetite. All the listed SFBs were trading at or below their book value, with the exception of one non-MFI focused SFB. The market were valuing these stocks at book value without giving much weight to the growth potential. Fast forward 1 year, all of the SFBs have shown sharp recovery in asset quality and turned profitable due to improvement in economic environment. This has helped improve the investor sentiment as well. Many SFBs have been able to raise equity and few more are in the pipeline to raise funds. SFBs raised equity of 936 crore in FY22. This number had jumped to 2,956 and Tier 2 capital of 800 crore was raised in FY23. SFBs have raised 1,136 crore in H1 FY24 and almost 2,100 crore equity are expected to be raised during H2 FY24. The bullish stock market also helped get better valuation. From this slide, it can be seen that SFB's valuation was high in FY21 and then moderated in FY22 and was similar to private sector banks. With improvement in outlook, valuation of SFBs improved in FY23 and continues even in FY24 with the expectations of faster growth rate. There has been a couple of mergers announced in SFB industry with AU Small Finance Bank taking over Fincare Small Finance Bank to expand its product and geographical presence. Slice Group taking over a Northeast Small Finance Bank, which was in need for capital and for inorganic growth. PMC Bank was acquired by Unity Small Finance Bank to protect the depositor base. We expect the SFB industry advances to grow around 23% for FY24, while many players might grow faster than that on an individual level. and the ROTA for industry is expected to improve to around 2.1% for FY24. Thanks, everyone. This is all from my side. I now hand it over back to Divya to take it forward.
Thank you, Ravi. As conveyed earlier, attendees are requested to key in their questions, which we will take up during our panel discussion. Now, may I invite Mr. Sudhakar Prakasam to take over the session. Mr. Sudhakar Prakasam is a director and ratings head at CareEdge Ratings. He has been working with CareEdge for more than 15 years, having credit rating experience across corporate infrastructure and financial service sector. He's also around 2.5 years of experience in the banking sector, handling credit appraisal of small and mid-corporate credit in a large private sector bank. Sudhakar is qualified as an MBA from BIM Trichy. Over to you, sir.
Thank you, Divya. Good afternoon to all the esteemed panelists and participants. It's with a great pleasure that I extend a warm welcome to each and every one of you. Thank you, Ravi, for the informative presentation. That's the stage for our discussion. As highlighted in the presentation, the journey and developments in small finance banking sector has been a topic of significant interest among various stakeholders, including investor community. And we hope that the knowledge shared today will be beneficial for all the participants. We are honored to have three highly esteemed panelists joining us today, and I express heartfelt gratitude to each of them for generously sparing their valuable time to contribute to this panel discussion. Before we proceed, it's important to reiterate that the views expressed by our esteemed panelists represent their individual perspectives and may not necessarily reflect the official views of the institution they are associated with. I would also like to quickly introduce our panel members to the webinar, and it's my privilege to briefly introduce each one of them. Our first panelist, Mr. Samit Ghosh, is the Non-Executive Director and Chairman of Ujjivan Financial Services Limited. He founded the company in 2004 and served as its MD and CEO until January 31, 2017. Mr. Samit Ghosh took charge as MD and CEO of Ujjivan Small Finance Bank Limited, effective from February 1, 2017, and he retired on November 30, 2019. Prior to founding Ujjivan, Mr. Samit Ghosh was a career banker with over 30 years of banking experience in India and overseas. Mr. Samit Ghosh holds MBA degree from Wharton School of Business. He is also non-executive, non-independent director of Ujjivan Small Finance Bank Limited. Our next panelist, Mr. P.N. Vasudevan, is the MD and CEO of Equitas Small Finance Bank. He started Equitas in 2007 as a MFI, and later the group diversified into other retail lending, addressing the segment that are not effectively addressed by other mainstream lenders. The MFI was subsequently converted into a small finance bank. Prior to Equitas, he worked with Cholamandalam Investment and Company. He had commenced vehicle finance in Cholamandalam in the year 1991 and ran it till 2005. Mr. Vasudevan is basically a company secretary and a law graduate. Equitas Group is also very active on its CSR activities, and through its foundation, it runs 8 schools in Tamil Nadu, exclusively catering to children from low-income families, providing them high-quality English medium education at very low fees. Our next panelist, Mr. Shrimohan Yadav, is an advisor in the financial services space with an experience of 29 years in Reserve Bank of India, wherein he worked in diverse areas, including supervision, regulation, rural development, financial inclusion, HR, etc. He was closely associated with the SFBs, including during the formative years, and every year used to conduct roundtables for CEOs of these banks. He has dealt their licensing and holding structure related issues and was instrumental in extending certain relaxation to this segment. He also has a long experience of handling microfinance and priority sector related issue when he was a faculty member in College of Agricultural Banking, RBI Pune. I extend warm welcome to all the participants who have decided the time to be part of this webinar. In case participants want to ask any questions on the presentation made or otherwise, they are requested to key in their question in the panel on the screen. Now we will begin our panel discussion and simultaneously take questions from the participants. Now my first question is to Mr. Samit. In the recent past, industry has witnessed 2 merger announcements, sir. How do you see the merger and acquisition in the small finance banking space?
Well, as far as merger and acquisition is concerned, we may see some because there are if you look at the small finance banks, there are three which are large: AU, Equitas, Ujjivan. And then there are smaller microfinance institutions, smaller small finance banks. And some of them may go through some kind of a merger or acquisition. However, I think you would also see, just like AU has acquired, FinCare, I think some of the small finance banks also acquiring businesses going ahead, especially because, one of the things which the Reserve Bank requires us, who are purely microfinance institutions, to diversify our business and build up our secured business. And to that extent, we've been trying to build up our affordable housing, MSME, vehicle finance, etc. But to add impetus to that growth, some of us may look to acquire some businesses in the secured business area.
Okay, sir. Now I would get the perspective of Mr. Yes, sir, Mr. Vasudevan.
You went off air for some time.
Okay, sir. Sir, given the recent merger announcements, do you see the consolidation happening in the small finance banking industry? What is your view on that?
See, the SFBs, if you go back to the origin, RBI guidelines, which started the whole concept of SFB, it was to promote financial inclusion in the country. And that's why, we have 75% PSL targets and 50% of loans should be less than 25 lakhs, etc., etc. So if you look at the financial exclusion situation or scenario in the country today,
yes, sir.
As per various NSSO survey and other government data, anywhere around 35 to 40 lakh crores is the total unmet credit demand from the informal economy segment. So if you look at 35 to 40 lakh crores of unmet demand, and if you say that SOBs are, conceived for the purpose of financial inclusion, then rather than talking of consolidation, we should be talking of more and more SOBs coming into the space so that we can really, make a serious dent in terms of financial exclusion, right? So in fact, I was giving some presentation in the RBI Staff College some time back. So I was showing a calculation that if all the current 12 SFBs grow at 25% per annum continuously for many years, it will take us about 65 years for the SFBs to meet this 35 lakh crore unmet credit demand. So that's the scenario. So my feeling is that, if at all any consolidation happens, it may be very, very, individual related issues. It's not a sectoral related issue. See, when do you normally have a consolidation at a sector level? Is when demand dries up, there's not enough opportunity and there are too many players, then the smaller players want to exit and the larger players are happy to acquire them and reduce the level of competition, etc. But in SFB space, that's not the scenario. I mean, the unmet demand is so high that, we need to grow at 25% for next 65 years if we need to meet the unmet demand. So M&A will not be driven by sectoral related issues. It will be, if at all it happens, it will be purely because of some individual, entity-based, scenarios.
Okay. So rather than shrinkage of number of SFBs through consolidation, it's time for have many more SFBs, which would be helping the RBI to achieve financial inclusion. Thank you, sir. Thanks for that view. And this question is to Mr. Shrimohan. Sir, one of the objectives of RBI setting SFB category was to further financial inclusion by way of providing access to credit and access to other banking products. So What is your view on the industry's performance in terms of achieving the set objectives?
So definitely they have achieved the objectives. If you see the PSL target, which is around 85%, then you also see the MSME maybe 28-30%, weaker section 44%. For a scheduled commercial bank, target is 10, but these people have done very good performance in weaker section. Then whether it is for a small and agricultural farmer also 25% as against the target of 18%. The data which I collected is from the annual report of RBI. The recent performance may be much better also. So they have achieved the objective. They have reached to small and marginal farmer. They have reached to micro entrepreneurs, and they have the branches across India, not only in the metropolitan cities and urban areas, but also in small places. And because they have been formed when technology has taken off, so there is no constraint on their reaching in the remotest area. So that the financial inclusion part also, if you see, they have done very well. So there is no doubt that they have not achieved their objectives.
Okay, sir. And this question is to Mr. Samit Ghosh. Sir, majority of regulations related to SFBs were formed in the initial years in 2014. Do you see there is a need to overhaul this regulation? If so, what would be your major suggestions?
See, I think one of the things which, as Mr. Yadav mentioned, and so is the opinion, fortunately for us, with most of the people in RBI, because I had recently had some interaction with seniors in IIM Bangalore, seniors from RBI. The small finance banks have definitely been successful in the terms of the objectives which the RBI set. And this compares with the previous not so successful attempts with RRBs, LABs, and payment banks, etc. So, and obviously we are also growing substantially, and there is, talk about why don't we apply for a universal bank license, etc. Now, given that these are specialized institutions, I don't know how much, and successful. I don't know to what extent RBI will sort of agree to that. But one of the things which we would certainly like, especially as our, the small finance banks, which have grown substantially and has shown a very good track record, is to reduce our capital adequacy requirement from 15% and bring it closer to the universal bank. And we can take, not only credit risk, we can take the operational risk and whatever risks are involved. And because that will enable us to more efficiently use our capital. So that is something which, if RBI, based on the performance of small finance banks individually, could ease up, that would be a good thing.
Okay, sir. Instantly, if you look at in the presentation, in terms of capital adequacy levels, all of the banks are well capitalized. But what we see is many of them have not been utilizing the Tier 2 capital to the full extent. Mr. Vasudevan, how do you see this scenario? There is a flexibility in terms of using Tier 2 capital, but many of the SFBs are not using to the fullest extent. How do you see this situations?
Yeah, so Tier 2 is something that we will use when two things happen. One, when it is required, and two is that when the cost is attractive. See, most of us historically have had a higher level of capital adequacy on Tier 1 itself. And then there's a regulatory requirement also, for SOBs to list within 3 years of starting operations. Right.
Okay.
And so we had to list, and which means that there's some amount of capital that we raised, and some of us have the holding company structure, and the whole code generally held a large percentage of the bank. It was 100% to start with, and so even after we completed the listing and completed with that portion, then the next rule of SEBI came in, which is that the public holding should be at least 25%. So again, we had to raise fresh capital to meet the 25% public holding norms also. So people have been raising equity for not just the growth purpose, but for some of the regulatory compliance purpose also. And so most of us are sitting on a high level of tier 1 capital. So tier 2 is something that we will probably look at when we reasonably exhaust the tier 1 capital by growing. And then finally, we need to raise capital only for the purpose of supporting growth. And that's the time when probably people will start looking at tier 2, of course, subject to cost, being in line.
Okay, sir. Sir, Mr.
I
Samit
just want
Ghosh has
to
to
I just want to
leave
add
due to
that
some. Yes, sir. Please
the
continue, sir.
cost, as Vasu has raised this, tier 2 capital is expensive, so
Okay.
we don't want to go into an expensive source of capital.
Okay. Okay. Fine, sir. Sir, I understand you have some exigencies you have to log off. In case you wish to log off, you can log off, sir. Thanks for joining to the webinar, sir.
I'll stay another 5 minutes and then
Yes,
log
sir.
out because it's
Okay,
good
sir.
to
Thank you,
see
sir.
Mr. Yadav and Vasu. Haven't seen them for a long time.
Nice, sir. Okay. This question is Mr. Shriram. So do you see any incentives for other set of lenders in the, say, cooperative banks applying for SFB license? Mr. Shrimohan, what is your view on this?
The cooperative sector converting into SFB, which was first was this UP bank, right?
Okay.
Which has set up a SFB. And there is a lower requirement. Actually, RBI has given a lot of incentive as compared to a normal MFI to convert into SFB or an NBFC to convert in an SFB. If a cooperative bank want to convert, the capital requirement is half of that.
Okay.
Actually, much lesser, and half of that is to be reached within a certain time period. That relaxation also has been given. Because you know that the governance is much better in SFB as compared to cooperatives for the reasons already well known. And they get access to so many other facilities, so many other relaxations, which otherwise not available to cooperative banks. But so far only one has come, and maybe one or two maybe in the pipeline. I'm not aware, but incentives are there. Incentives already RBI has been built in.
Okay. Okay. This question is to Mr. Samit Ghosh. Sir, in the last few years, SFBs have traveled a long way in terms of achieving certain metrics in terms of CASA proportion, CD ratio. Given that they have been under a transition period and also seen a lot of external shock, we understand a lot of interests are there for the existing SFBs to convert into universal bank. What is the advantage you see moving into your universal bank, and is the time right to move to the next level, sir?
So, this I mentioned earlier, there's been a lot of items in the press about SFBs going for a universal bank license.
Okay.
But I'm not sure because, we are maybe victims of our success,
Okay.
because SFBs have been successful in terms of achieving the goals which RBI had set. Whether RBI will be very keen to change that, I'm not sure. But as I mentioned, if the RBI progressively relaxes the capital adequacy requirement, taking into account that we take, of all the risks which we have, not just the credit risk, that is something, at least personally, I would like to see, because that will be a much more efficient way we can use our capital, because today we are hampered by that compared to universal banks.
Okay. Okay, sir. Sir, this question is to Mr. Vasudevan. Over the
I'll
years, yes, sir.
Yeah, thank you. Goodbye. Sorry.
Thanks for joining webinar, sir.
Thank you.
Thank you. Yes, sir. Sir, over the years, we have seen SFBs have improved the CASA ratio. However, still there is a large gap exists between the universal banks and the small finance bank. How do you see the SFB's ability to bridge that gap? Will they be able to reach that level of universal banks?
So if you look at SOBs, and if you look at the two sides of the balance sheet, on the liability and on the asset side, on the asset side, largely our customers are from the informal economy borrowers, small borrowers, people who are typically from the low income segments. Now that segment of people do not really have much of excess surplus cash to place as a deposit in the bank. Okay. So when we want to raise money deposit, we have to go to the middle and upper middle income category of people, which is where the surplus cash is available. And when we go there, we are actually head on in competition with all the banks in the country, every single bank in the country, starting from State Bank of India onwards. We are in competition with them. And so how do we meet that competition, and how do we win a depositor from, let's say, State Bank or from a HDFC Bank or so, whatever it is, some of those large banks? So it's going to be a struggle to raise this low cost deposit. The TD that we have raised is also at a higher cost compared to the large banks. Almost all the SFBs we are paying anywhere between 1% to 1.5% higher on the TD rates compared to the large banks. And when it comes to savings also, we are paying, we pay 7% interest for most of the slabs on savings. There's some slabs which are lower, but most of the slabs go at 7%. So we are able to get money only because of the fact that we are offering a higher interest rate as on date. And if you look at it from a depositor perspective, the day that we reduce our interest rate, will this money go away from the bank and go to the larger banks where the difference in rates is not much? So the way we can bite that bullet will be only when we are able to offer the same level of services as well as products to a depositor that the large banks offer. So many of the SFBs have done well in terms of certain level of services, our physical service at a branch or our digital service through the IBMB apps and all that are maybe generally not that bad, maybe reasonably comparable to any bank in the country. So that way services were, I think, more or less in line. But when you come to products for a deposit customer, they need to have products where the account has to become used for that product, like a personal loan or a credit card or a car loan or a home loan or any of these consumer loans. If they consume from an SFB, then they will start paying the EMI through that account. And so that account will get more and more used. And when they start using it, they will start funding it. And so the account becomes sticky, the relation becomes sticky. And at some point you drop your interest rate, the money just doesn't move away. So that brings us to the question of, what level of products are we able to offer from the SFB segment? And currently, almost all the SFBs, we do not offer any of these products because the interest rates on that in the market is so low that most of us are not able to compete at that rate. So we are not able to offer those kind of products. And so for some time, the SFBs will pay higher rates and it will be a uphill struggle to keep improving your CASA ratio. But over time, as SFBs, mature, stabilize, and are able to attract deposits without too much of differential interest rates, that's the time you will see that we can offer more loan products and get a better relationship with the depositors. And through that process, reduce our cost of funds and improve the low cost deposit ratio over a period of time.
Okay. So for SFBs to compete with the universal banks, the way forward is to offer a bouquet of products so that you are able to retain the customer, the stickiness increases. Thanks for that view, sir. This question is to Mr. Shrimohan. Sir, in banking parlance, when we say CASA, it denotes low cost deposits. But in case of SFBs, while they have been successful in terms of improving CASA ratio, so still they are not really a low cost.
Hardly 6-7 years. It takes about a decade to come to know about the institution and about the sector. And luckily, most of them have stabilized already. And you will see the changes after the next 3 to 4 years when about a decade will be complete. And as Mr. Samit Ghosh also said, this model has succeeded actually, unlike RRBs or local area bank, where the model was somehow not sustainable. They are also doing the financial inclusion. They are also serving the small segment. But sustainability is a very good advantage here. The model is that you have a very good net interest margin. The NIM is very good. The capital is adequate. The technology is fully utilized. So this is a sustainable model. Of course, it will take some time. I am sure that all the SFBs are working to reduce their dependence on institutional resources. That's why the CASA is not going up. But as Vasudevan said, some more effort, some more maybe cross-selling, some more innovation in product may be required. So to make them sticky and to CASA to increase. But it is a slow journey. It's not that you can do it overnight. Slowly it is increasing also. But yes, some more. The positive thing is that their customer service is much better than the much better than the I will not use the word of which segment, but better than many other banks. The personalized service, the personal feel, the local feel. So there is no doubt that they will not increase the CASA. Maybe it is only a part of time, and some more products, some more innovation, some more cross-selling will take them to this path.
So as a SFB customer, you don't feel small when you deal with
in fact, my most of the deposits after my retirement are with SFBs only. So I have full faith that that's what I am saying. And they, of course, they are paying 100 BPS to 200 BPS higher than the other banks. And then DICC coverage there. So if this is for small people, up to 5 lakh coverage, DIC coverage there is no reason to have any fear from any SFB. Otherwise, also they are strong. But what I'm saying that even for a common person who generally keeps 1 lakh, 2 lakh, 3 lakh rupees, there is no fear that their money will not be safe in SFB. That awareness has to be created more and more.
Okay, sir. Mr. Vasudevan, what is your view on this small finance tag? Has there been any suggestions from the industry in terms of changing the word small finance?
Yeah, that's actually a big drag, seriously, because nobody knows, because it is not something which we have seen in the country before. So we've never seen that name in a bank earlier. So people definitely get confused. They don't even know whether we are really a bank, or is it something, something not very clear. What is it? And initially, when we all got the license, that time we had made a large amount of representation, and we met RBI officials quite a few times trying to tell them that, please don't, put a millstone around our neck as we just step out into the market to raise deposit for the first time in our lives. But they just couldn't accept our request, and it was turned down. And now we have grown to live with it. So now I don't think we are even representing that any longer. We have given up, and so we have now learned to live with it. And over a period of time now, people have seen, at least for 6-7 years, they have seen this word small finance. So somewhere they believe that, okay, fine, these are also a bank, except that they feel that you are only a small finance bank, you have to pay a higher rate of interest. So they feel that getting a higher rate of interest is a right from a SFB, and an SFB is absolutely not justified in offering, comparable rates to the other large banks. So they feel that you are really not a full bank. So how can you say that you won't offer a higher rate? You have to offer a higher rate. So I think it's something that we have learned to live with.
Okay. Sir, in terms of credit deposit ratio, we see over the years SFBs have improved. But still, most of them are above 85%, which generally pursued as a reasonable credit deposit ratio. How do you see this SFB's ability to improve the CD ratio in the near term and long term?
So, see what happens for SFB is that our capital adequacy is higher than the universal banks, and so we have our out of our funding of the asset side, on the liability side we have 22, 23, 25% of the liability coming from capital. Right, that's a big input for SOB compared to universal banks, where typically the average capital adequacy may be 15% or 16%. We are almost 8 to 10% higher. So naturally, we will not borrow so much of deposit because we don't need so much money. That's one. Second thing is that SOBs also we do take refinance from the institutions. The rate at which the institutions refinance loans, that rate is at a level which is comparable to the deposit rate of SFBs. So we feel comfortable borrowing because we don't have SLR CRR requirement on the institutional refinances. But large banks typically don't borrow much from the institutions because at that rate it is high for them. And so they don't want to borrow, but we are very happy to borrow because from compared to our deposit rate, it's quite in line with the benefit of SLR CRR not being there also. So we finance or we fund the asset side by a combination of capital, which is generally at a very high level, refinance, and then the remaining deposits. So because of that, naturally the CD ratio will be on the higher side for SFBs. So maybe only as we grow larger and somewhere that capital adequacy also should come down. Maybe if we become a universal bank, then our CD ratio can also be starting to be in line with the rest. But till then, I think our CD ratio will be a little bit on the higher side.
Okay, okay, sir. This question is to Mr. Shrimohan. Sir, in terms of asset quality, we have seen during COVID period, there have been challenges, mainly in the MFI asset class, same as impacted SFBs also. But in terms of non-MFI portfolio also, the asset quality has been relatively moderate. Do you see the scope for improving underwriting, or still you think the underwriting practices are evolving in the SFB industry?
Yeah, you remember that during COVID time, the most adversely affected people were either micro finance borrowers, small businessmen, right? And
Yes.
MFI sector also was badly affected. This is not only for SFB, I think entire MFI. And because most of the SFB have been converted from MFI, and their large proportion, as just now you show in the slide, about 60% excluding AU, about 60% was to MFI sector. So when these people were affected, naturally, in due course, it was bound to affect the asset quality of the SFBs. But as the things improved, these people recovered very fast also.
Okay.
This micro borrowers and even small businessmen, they have bounced back. And the asset quality of GNP level has gone down. The net NP level also have gone down. One more thing, if you notice, their GNP level have never been above the PSBs. The industry, if you see, even industry as a whole, I was saying, industry itself was 5.8 at end of March 22, and SFB GNP was only 4.9. So even if we include private banks and PSBs and all the entire sector, it was much lesser than that. Of course, net NPA was slightly more. For the industry, it was 1.7, and for SFB, it was 2.0. But I don't see that going forward there is any challenge on this issue. But yes, underwriting MFI, they are very well experienced. So for MFI sector, small business, they are well equipped with the underwriting skills. However, when they are to diversify in other segments like retail and SME and maybe corporates also, they have to acquire those skills, and they have to be careful while venturing in these areas, because a very good underwriting skills are required. Otherwise, they may burn their fingers.
Okay. So do you think that 75% lending to priority sector, one of the mandates, it's impacting the SFB performance in terms of profitability and asset quality?
No, I don't think that, because within PSE also there are a lot of areas which are highly profitable areas.
Okay.
As soon as we say PSL, we should not think that it is only micro and very small farmers.
Yes.
Right. If you see the PSL circular, loans up to crore rupee, 2 crore rupee, maybe 50 crore rupee to solar power system and various other type of organizations, very big loans are being covered nowadays. And then medium enterprises are also there. If not, SME includes micro, medium, and small.
Yes.
So if various enterprises which are falling in the definition of micro are coming in micro, but in PSL other categories also coming. And it depends on your how underwriting quality is there, and these are there are profitability within the PSL also. I don't think it is a drag as of now. And
Okay.
I don't think any SFB as of now is complaining too much that we are not able to achieve. By default, they are able to achieve. Maybe
Okay.
there is some time, but there is not big issue as of now. As of now, going forward, when they diversified, they may raise this demand. And there was a one line in a RBI policy, then when that guidelines came, that RBI may review after 5 years or so. Maybe if not 5 years, maybe in next 2-3 years, it may review certain guidelines.
Okay. Okay. Mr. Vasudevan, as highlighted by Mr. Shrimohan, achieving PSL target of 75% was not an issue. But do you think any relaxation in terms of, say, 75% to some lower level would give more elbow room for the SFBs to operate and improve other performance metrics?
No, I don't think so, because from the beginning, none of us really had any issue on the 75% stuff. I mean, we knew it right in the beginning, and it was there in the guidelines itself, and so we walked into it with our eyes open. And if you look at it, most of the SFBs we actually sell excess PSLs in the market.
Yes.
So yeah, so I don't think that's an issue for any of us.
Okay.
And it doesn't affect profitability or anything. As Shrimohan mentioned, to lend to these people is not necessarily an unprofitable venture at all.
Okay.
I mean, you can get a decent spread by lending to these people. So I don't think any of us have an issue on that side at all.
Okay. Okay.
In fact,
yes, sir. Yes, sir. Please.
Sub-segment of micro and small farmer, I think, please correct me, Mr. Vasudevan, if I am wrong. Maybe some of the SFBs are making money also by selling the certificate.
Very true. Absolutely. There's a lot of demand for SFM.
Okay. Okay. Sir, we have a few more questions from audience, but due to paucity of time, I will limit to this final question to Mr. Vasudevan. Sir, how has been the technology helping the small finance banking industry in terms of improving operating efficiencies or improving profitability?
See, technology is, we look at it from two angles. One is technology used for improving the efficiency of the bank, efficiency of our processes. Okay. Now that is something that we have all been using it all our life, wherever we have worked, and all the banks have been using it. We were an NBFC, so we were using even as an NBFC technology to try and see how to optimize, how to improve efficiency of our internal processes, or transaction management and all that. So that is one thing which is something historical, and all of us have been doing it, and it keeps improving all the time with latest developments. But the other part of technology, which is a digital customer-facing digital channels for the purpose of acquiring business, not for servicing, but for acquiring business, acquiring new clients, acquiring business. Now that is actually the very interesting space that many of us are focused upon. And when when we look at digital, when we come to the digital platform, right now, if you just go to the physical world, we are a SFB, we are a bank. Okay, why do I call myself SFB? I am a bank, which is 1/100th or 200th of the size of some of the large banks. And they have invested anywhere between 5,000 to 20,000, 30,000 branch network at a historical cost. If I have to replicate a similar 5,000, 10,000 branch network today at today's cost, it's going to be a huge impact on our operating cost. So when I look at the physical world, I don't think I can ever match up to these guys ever, seriously. But when I come to the digital world, if I am a 2-year, 3-year-old digital, capable or experienced bank, the other banks are either the same or less. So there's really not much of a difference. So that is where we are all looking at digital to see how do we scale up on our digital capabilities to acquire customers, acquire new businesses, without relying too much on the physical, infra part of it. And through that, actually, we can improve and be very competitive compared to any bank in the country. So digital and technology. So I would like to break it into these two, and that's how we look at it.
Okay. Mr. Shrimohan, can you give your views on the same in terms of technology? How do you see?
Yeah, I correctly said by him. As you see, they can leapfrog from the advantage which they have, unlike the old private sector banks. So, and this nowadays, that banking is not a place where you go. Banking is a place what you do. And most of in the cities and urban area, most of us don't go and visit the branches, except some rare occasion when we need something. But normally, all the banking can be done through internet banking, through mobile banking, and for them also it is a very low cost as compared to physically dealing with. I don't know the latest figure, but when I was in CAB Pune, we used to give this example that if a customer walks into the branch and even if he withdraws some 1,000 rupee, the cost was 50, 60 rupee. Definitely it would have gone to 200. But if he does the same thing on the ATM or does a transfer through UPI, the cost is hardly 1 rupee per bank also. So that is the advantage, and that is the going forward the way, not only for SFB, all the banks, that we enhance our footfall only through digital lending, and a lot of cross-selling opportunity can be there if our application is well designed, and there is not much need of opening so many branches. Yes.
Okay. In fact, in the recent past, we have seen a lot of entities coming in the name of fintech and providing services. I think with the long-standing experience of servicing different kind of customers, offering different products, SFBs are in a better position to use the technology to gain scale and leverage. Now I request Divya to conclude the session.
Thank you, Mr. Sudhakar, for moderating the session, and Ravi for your presentation. Thank you once again to all our guest speakers for their insightful views. And thank you to all the participants for taking the time out and being a part of this CareEdge webinar. For any further queries, feedback, or suggestion, please write to us in the feedback mail. Goodbye for now, and I request the tech team to kindly log off.